Welcome to the Life Unlimited podcast with Larry Heller. You deserve complete financial advice so you can confidently live your life your way, for life. Now, let's get into this week's podcast episode.
Hello and welcome to another Life Unlimited podcast with your host, Larry Heller. Today, we're going over the 7 common financial planning mistakes and how to avoid them. All right, Larry, we got a lot of ground to cover today, brother. So where do we begin?
A lot of ground to cover, and so many of these that come up when we meeting new clients, and really kind of some of the reasons why clients work with us and work with a financial planner because they're not aware of these mistakes and these issues. So let's kind of get into them. And the first one is really not knowing your tax bracket. So I would say we ask a lot of people what the tax bracket is, and 90% of them have no idea. And really, their accountants are not really looking at their tax bracket and giving them any type of planning advices. But so you can lose a lot of money by not knowing what your tax bracket is and making decisions that can minimize what you're paying. That could be tens and sometimes hundreds of thousands of dollars over the years. So, for example, Roth conversions. So this has become really popular, especially after you retire and you may be in low taxable earning years before you're taking your required minimum distributions, which are being pushed out now to age 73 and age 75. So there may be some years where you can fill up some of the lower brackets by doing a Roth conversion and avoiding being pushed in some really high brackets later on, forgetting about even the possible planning for the next generation. So knowing your tax bracket will help making decisions on whether you should do a Roth conversion and how much should you do in a Roth conversion. So that's one on the not knowing your tax bracket. 2, taking advantage of the zero capital gain brackets. Now, I know these numbers may be low, but there are maybe some years where you fall into this for whatever reason that, again, maybe you're retired, you're not taking Social Security yet. And if you have less than $89,250 as a married filing joint, of taxable income, you can sell something that has a gain in it and pay 0 taxes. That's right, 0 taxes. So don't miss that opportunity. If you're single, it's a little bit less, $44,625, but don't miss that opportunity to maybe getting rid of a stock or a fund that you are holding on to because you don't want to pay taxes on that. So that's number 2 of the knowing your tax bracket. And the last one is, charitable deductions and knowing, should you bunch that? Should you do a donor advised fund? Should you do a QCD if you're eligible from your IRA? So really figuring out kind of the best ways of doing the charitable deductions and knowing your tax bracket so you can know how much you're actually saving by doing them. So that is planning ideas, number 1, planning mistakes that people make that they can avoid, number 1.
Well, and number 2 is something I know that you and I have talked about before, but it's also something that you have to pay very close attention to as an advisor, because this is kind of a scary, slippery slope, a behavioral thing, which is chasing past investment performance.
Yes, it's so easy when someone says, well, how much is this making? And how much did this make in the past? And looking at that, and people look, oh, wow, it made 20% last year. I want to go in there. Or it's averaged 20% over the last 5 years. I want to go in there. And that may not be the best thing going forward, even though it was the best thing going back in the past. So trying not to chase that into looking at areas that may have not performed as well, not because it was a bad investment, because it was maybe out of favor or out of cycle. And that may be kind of what you want to get into. But emotionally, people want to kind of buy things that are doing well and sell things that are doing not well. And a lot of times you want to do just the opposite. So you want to kind of sell high, buy low. And then another thing is, rebalancing. So looking at it. So even though it's doing well, maybe you want to take some of the profits off something and move that into something else. So not looking at rebalancing. We look at rebalancing 4 times a year, but a lot of people never rebalance. I have so many people that, have put their money in an allocation in a 401k and haven't looked at it for a decade or more. So rebalancing and making sure that you're not overweighted in a particular asset class or a particular stock. It's really easy to get emotional with stocks and get it too overweighted. So chasing performance is really one of the ones that we see as a financial planning mistake.
Yeah. Well, and we had just a couple of days ago, and I don't know when that episode's going to drop, but we just had Allison on to talk about some of the estate issues, which wonderful podcast. She was absolutely fantastic. And the things you're going to cover today were some of the big points that she said are huge financial planning mistakes.
Yeah. So a lot of during the first year when clients come aboard, one of the things that we do is we take a look at their estate planning documents, their wills, their power of attorney, their healthcare proxies, because a lot of times people go to their attorney, they get their wills and they put them in drawers, and it's years again before they look at that, which is one of my other planning mistakes later on. But going through these and making sure that you have the right time. First of all, making sure that you actually have all these documents. A lot of people, you'd be surprised, even, people older with children don't have these documents because, again, they haven't taken the time to do that. So making sure that you have the right documents, but then making sure that you update these when you have, potential changes. Whether you need to change an executor or a beneficiary. So looking at your planning documents and making sure that they're up to date. And then also the beneficiary, making sure that you have the correct beneficiaries. We've seen times where they're missing a child in one of their beneficiaries, an adult child, or there's an ex-spouse is there. So making sure that your planning documents are really up to date, accurate. So that's one of the kind of planning mistakes that we see. They're not having them or having ones that need to be updated.
Yeah. Yeah, I've never actually shared this on this show, but when I first got into financial services consulting, I was meeting with one of my first clients, and we were just going through their business model and all of that sort of stuff. And one of the things that he had asked me is this next mistake, which is making sure you have liability coverage. And Larry, I called my insurance agent and said, I need liability insurance. And she's like, nobody has ever called me and asked me for this. And I was like, look, I know, but I just talked to this person and they told me how important it is. So I'm not going to take this topic, but you want to elaborate on that?
Yeah. I mean, this is kind of a quick one, but there's 2 important features in here is really, having enough liability coverage. Now, what are we talking about here? We're talking about if you get into a car accident and get sued, somebody slips in your home. Yes, your home is going to have certain coverage. Your auto is going to have certain coverage, but you are potentially liable and could be sued for the value of all your assets. So how do you protect those assets? And one of the ways is having a liability coverage, what's called an umbrella policy, so that all of your assets can be protected by having a policy. And it's usually not very expensive or costly to have this, but making sure that you have the right amount. And a lot of times, yeah, people may not have, they may have some, but they don't have the proper amount. And there's one key area in these umbrella policies that one of the property casualty, actually an attorney, what is the attorney's names that they sue for injury? Personal injury attorney. So who actually kind of, brought this up and said, make sure that all your clients in the umbrella policies have an uninsured motorist clause. Because it may be in your auto policy, but it may not be in your umbrella policy. And if somebody hits you and in a car and there's millions of dollars of medical and things that and recoveries that are not covered, and your umbrella policy doesn't have that, for you could be on the hook for that. So making sure that there's an uninsured motorist clause in your umbrella policy.
Yeah. Now, this next one here is something that is being talked about a lot in financial services at a lot of conferences right now, is this great wealth transfer. And so there's up to $80 trillion that's going to be passed down over the next 30 years from baby boomers to the next generations. And your financial planning mistake here, I think, is the crux of what most financial professionals aren't doing, which is making sure that the heirs really truly know what's going on. And you even have a story surrounding this. So let's dive into this one.
Yes, I have a few stories, but it's sometimes it's not even just the heirs, but it's the non-financial spouse who may not really be interested in, and there's one spouse that takes care of everything. And when that person passes away, either the spouse or the children, now they need to kind of become a detective. But the detective where's the insurance policy? Where's the wills? Where are all the investment statements? We actually had one a long time ago. A client actually came in wheeling 3 boxes, and they dumped the boxes out on our conference room table because they had no clue where to start, and that was everything that they had. We've had an instance where a child almost paid for their mother's funeral for a second time, that their father had actually prepaid for their funerals, never told somebody. And literally right before when the mother had passed away, there was an aide, and the aide actually found the document right before the child was going to pay for the funeral for a second time. And then we actually had, this is an interesting one, I called the doctor story. It came actually because of my mom, is that my mom was being rushed to the hospital and she wasn't able to communicate at the time. And they asked me, who's a personal doctor, so they can get all the information on her. And I'm like, uh-oh, I had no idea who my mom's personal doctor was. So knowing who maybe your spouse's personal doctors are, or your parents' personal doctors, in case you're in that situation. And one of the things that we do, and one of the kind of benefits of working with us, is we have what we'll call a client portal, an online portal. And one of the places on the portal is our key information sheet, where you can write down where your doctors are, who your accountant is, who your insurance person is, with contact information. And of course, the whole portal has all the different investments, where they are, where they're located. It just will make life so much easier for the next generation. And I can't tell you how much feedback we get from clients that say, this is unbelievable, this is great, I'm so relieved that there's a place that that my children can come to in case something happens. So uninformed heirs just makes life so much more difficult, and we've seen it happen so many times.
And if you're not a client of Heller Wealth Management right now, and your advisor hasn't had that discussion with you, that's not a cool thing to have happen. And I also need to just go back and say, please don't bring in 3 boxes full of stuff and pour it onto Larry's table and say, I don't know what to do with this, even though he's totally qualified to do that. That's not like a super fun day for the firm. So, all right. So the next one is a huge behavioral thing. And I know that you have lots of training in this and you have lots of experience in this, which is, improper spending. And this can go 2 ways, right? So it can go that people are overspending in retirement, or that they're underspending on retirement. Let's break both of those down, please.
Yeah, we've done a couple of these podcasts about retirement planning and doing that. But a lot of times when people come in and they're thinking about retirement, but they have no idea how much money they need in retirement. And usually the first thing is that we ask is, well, how much are you going to spend? and we get vague answers. Oh, I think it's this, or I mean, there are a few professions with engineers who come in with spreadsheets exactly to the penny what they're going to spend, but most people, they don't, they don't know, and you can't really put a retirement plan together without knowing what your expenses are going to be. So the first thing is really making sure you kind of know what your expenses are going to be. So once you know what the expenses are going to be, you can figure out how much income that you're going to need at that bit and where you're retiring. So then figuring out kind of what the income is going to be from your Social Security and other pensions, so you can create a cash flow analysis to see, okay, based upon the investments that I have and the income I'm going to make, is it going to meet my expenses or is it not going to meet my expenses? So really knowing those things, and I don't even know how you would retire without knowing all these things, but there's a lot of people out there that don't, and I guess that's why sometimes they worry a lot. They have peace of mind, don't have any peace of mind, and a lot of that they underspend because they're fear that they're going to spend too much. So when we go through this analysis and we're able to do this now, I would say that they're almost all the time when we do that, they can spend more money that they're actually planning on spending. So making sure that you're properly prepared, making sure that you have a withdrawal strategy. Because once you figure all this out, where are you going to take the money? Do you take the money from your taxable account? Do you take your money from the Roth account? Do you take your money from a qualified account that you haven't paid taxes on? So not planning for the most tax efficient withdrawal strategy is a huge one, and and we spend a lot of time figuring out how to maximize the withdrawal strategy to minimize the taxes that you're going to pay.
Yeah, I wish I would have been a better podcast co-host, because I would have grabbed those episode numbers, because I remember specifically doing, spending too much and not spending enough. So please make sure that you go back on wherever you're listening to this episode and find those episodes, because they were really, really complete. They were really, really good. They were really good ways for you to have this conversation, especially with your significant other, because a lot of times it's actually that's the issue more than anything. But it's also really important to look at it from a money relationship and how what your feelings are and how you were raised around money, your emotions surrounding all of that stuff is very, very powerful to pay attention to. And it's something that a really great financial planner will be very comfortable having that conversation with you, as Larry just kind of previewed. So, we've gone through some of this stuff pretty quickly, Larry. In this last one, I feel is where we really get the rubber meets the road. I think the first one here, not really knowing what your tax bracket is, to, chasing past performance, estate issues, especially when it comes to beneficiaries, not having good liability coverage, your heirs don't know what the heck's going on. And then the spending component, all of this is really solved, or at least addressed, in this final one. So what's number 7?
Yeah, because number 6 kind of ties it all in, because if you've done number 7 ties it all in, because if you've done all the 6 ones, you can't just not do them again. You kind of, you want to review this. Some should be reviewed annually, some maybe every few years, because life changes. And your plan should change along as where life changes. So, some of the ones that we look at are the retirement planning. We talked about that. If you're putting certain goals in, how much do you need to save? How much do you want to save to retire at certain years? Knowing the rules about how much you can put away each year. What's the max? What's the contributions? We'll talk about this next year in 2025. But if you're 61 to 63, you're going to have a super catch up there. So there's, making sure that you change your withholdings to make, if you're 61 to 63, so you do the max for that super catch up. College planning. If you have, younger children, they're going to go to college. You're on track to meet their expenses. How do you do that? If you have a leftover 529 plan where kids have gone, they've changed the rules on that. And maybe now you can convert some of that 529s to Roth for your children. Insurance needs. I mean, we talked about the umbrella policy, but all your insurance policies should be reviewed each year. The estate planning news, we talked about the estate planning documents, but we have a mandate that every 3 to 5 years, all your documents should be reviewed again, because things have changed. In 3 years, we've actually gone in and we've looked at the power of attorney, and the power of attorney had passed away, and the document wasn't updated. Or the healthcare, oh, you know what? I don't really think that's such a great person to have as my healthcare proxy anymore. Or my children are old enough, so now I may have my brother, but you know what? I want to make my child there. So going through and making sure that you update all this is important. And then on the your investments, looking at your allocation. I mentioned before the 401k plans, and when we do some seminars and we talk to 401k participants, and they're not looking at that except for the first time. And as you get older, your allocation may change, and as you're maybe in your retirement, the allocation should change as you need a withdrawal withdrawal strategy. So looking at the investments and on an annual basis, at least for yours, we look at it obviously a lot more than that. And then updating your goals and your, things change. People, first come in, that I'm going to stay in the house forever and I'm going to do this, and life changes. And now, you know what? I don't think I want to stay in this house for forever. I want to move here, and it's going to cost me this, or I want to buy a second home. And now, how does that come into the equation? And taking into consideration, inflation and the market values. So, doing all the things that we talked about in the first 6 steps and looking that on an annual basis.
Yeah, man, we covered a lot of ground today.
We did. I thought we'd take us a little bit longer, but it took us a little bit faster. But if you listen to all this, you may want to go back and listen to it again, because there's so much information in those 7 steps, and there's so many things that if you're not doing, you should be doing.
All right, Larry, if somebody wants to reach out and find out more about how they can work with you, where do they go?
Go right to our website at hellowealthmanagement.com, and you can click on the button there and you can schedule an appointment with me or one of the advisors, or feel free to reach out to the office at 631-248-3600.
All right. So for Larry, this is Matt Halloran, and please understand, we covered a lot of ground today. This is one of those episodes you should probably listen to 2 or 3 times, but even better, there are lots of people who are making these mistakes. And as you heard the show, you thought to yourself, gosh, Jane has made these mistakes before. Johnny's made these mistakes before, or they just brought this up at dinner the last time we were over at their house. This is a perfect opportunity for you to gently provide some nice education for them without coming across as a schmuck or being too pushy. So with that, I will see all of you on the other side of the mic very soon.